Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast for the week ending on May 10th. My name is Ian Saunders, and I am thrilled to be joined this week by Steve Raymond. Steve, it's good to have you back on.
Yes, thanks for having me. Always appreciate sitting down with you.
Yeah, it's good to be sitting across the table. It's good to be sitting across coming into a new month, a new season, right?
Yes.
We're getting into the month of May, kind of heading towards the summer. It's been getting pretty hot here in Richmond, Virginia.
Started to.
Right, and with the change of the month comes about kind of a change of seasons, right? It comes about the seasonal evaluation for some of the big models that we have on the site. So, being as you are the originator of the fund scores and the FSM fund score method models, obviously no better person than yourself to come in and talk about some of those changes. So I think
very kind of you.
These scores have been around for quite a bit, right?
Yeah.
And it's a robust but simple scoring system. I think if I had to describe it, try to describe it succinctly, we have a fund score for all ETFs and mutual funds. I'm gonna do my best to just try and explain it. You tell me where I'm wrong. But the fund scores, all ETFs and mutual funds have a score that goes from 0 to 6.
Yes.
0 is the worst, 6 is the best. There's three main factors that go into those scores, just to give people background. Individual trend of the fund itself, right? Market relative strength, and then peer relative strength analysis. So you have individual trend, how's it doing against the market, how's it doing against other like funds, and those all kind of come together with different factors in each. But that, at the end of the day, we add all those together, and then we get a score somewhere between 0 and 6. Is that right?
Right. And the intent of that is to originally, because scores go back to pre-2000. I mean, when they were invented, and asset class group scores were more of 2002, 2003, culminating that data. The idea is the presupposition that you have a lot of inventory possibly available to you, mutual funds, ETFs, so on and so forth. And that you need an apparatus to say, just show me the ones that are working very well in this particular type of market, in this market trend. Who are the leaders? And we digitize that score from 0 to 6, so you could have a 5.5 and a 5.6 and all these things. The idea is to go with, in a sense, relative strength leadership, or you could say momentum leadership is who are the strongest, because that's who I want to work with in this current time frame.
Right.
Some time frames are monthly, other people, we have quarterly, let's say. Those are the two most popular time frames. So the purpose of the score is to quickly identify numerically, where the strength is, so that individuals or model engines or the like can quickly read that data and say, we're gonna make a change, or we're not gonna make a change, but this is who we're going with. This is the leader.
Right.
And so that was the idea. The second backdrop idea is that, if you didn't have a fund score, you need to be a chartist, look at charts, look at that chart, this chart, that chart, and then do it across multiple potential inventories. And quite frankly, I thought it'd be overwhelming for most people to do it that way. So this way is a much faster recognition of where the strength is. And of course, computers can work much faster with a digital score. So those are some of the reasons why it got developed. And then of course, we've gone down, some near approaching 30 years of history.
Just a few years.
Yeah.
Just a few years, right? And so we have these scores for all ETFs and mutual funds on the site. And then what we've done with the FSM fund score method models is to take baskets of funds that all have these scores and then simply use that score to say, what funds should we be in right now? Right. And so for those that are subscribers to the research platform, you'll see on the models page, any model that has that FSM tag right before it, it designates that, hey, this is a fund score method, fund FSM model. This model uses fund scores to pick its holdings, is kind of the approach. And many of those models, or all of those models, right, are evaluated. All of them were evaluated over the past week. But some of the models are looked at the end of each month. So we go in, we take an inventory or basket of scores, and we check it for whatever the highest scoring funds are at the end of the month. And then the model's going to hold the top end of that, however many it's designated to hold.
Right.
But the more I guess the older models have been the what we call the seasonal
Yes.
evaluation, which is what we just went through. So we're looking at seasonal quarter evaluations rather than, so still 4 times a year, still quarterly, but looked at on kind of off calendar quarters. Look to
Right.
capture some of that market seasonality, right? We have
Right.
the that I guess the classic adage, which we can debunk or hold up or whatever,
Yeah.
the sell in May, go away, come back in November. But
Yeah.
just to get in that framework, you're evaluated beginning of February, May, August, and November.
Correct.
So we just had beginning of May evaluation come in, and we look at those seasonal models and see what's the strongest funds within those inventories, right?
Yeah, in fact, some of the pressures in the older days was the idea that with using mutual funds with models, you're not allowed to trade them every 30 days.
Right,
And so
right,
there
right.
was a 90-day window or 91-day window kind of mandate that that we would seek to work within. And then that really occurred to me that well, okay, which 91 days makes sense. And so the seasonality of the market is a well-known phenomenon. Some people cast it as November through to May as kind of a seasonally strong cycle, and May, back to November again as a seasonally weak cycle. Our observations, and certainly my observations, is not that one's stronger or weaker than the other, but that often changes occur in leadership in near those times and in those quarters. And quite frankly, I think that we certainly saw changes at the beginning of the November cycle from a market being negative to positive in general.
Yeah, that's
then
very. I mean,
yeah.
you talk about, I think what the bottom for the market or in the correction last year was what, October 28th.
Yeah.
3 days later, new
Right.
season will come in,
Yeah,
and that strength really took off.
Yep. And so those types of things are what I would say are more important, is that you want to show up at better times than quote unquote worser times, and take advantage of those changes that may occur. And if no changes occur, that's fine. We stick with where we are.
We ride the trend.
Right. So the seasonal quarters have been attractive, and quite frankly, historically, the seasonal models, do very well, in some cases better than a monthly model.
Why do you think that is?
Because you're allowing assets to be held and then give them a chance to breathe and make progress.
Kind of like we saw in April, with a little
Right.
bit of a breathe, kind of
Right.
turn taken back, but
Well-
that didn't change too many of scores.
Yeah. Well, what can happen in a monthly model or a 2-week model is that you don't even give the asset enough time to breathe before you sell it
Right.
and move on.
Right.
And so this idea of repetitive changes actually usually is historically not as helpful. So you're looking for that blend. And so I know that the blend's going to lay in between monthly and seasonal, use both. But even as we approach this seasonal marker of May, we started to see some changes occur in April that kind of blossom into May. Not that the market necessarily is positive or negative type of change, but that some of the underlying sectors and some of the underlying
Other stuff is pushing through.
other stuff
Yeah.
is punching up there.
And so let's talk about some of those changes, right? We have a lot of different models. We don't probably have time to run through all of them today, right? But I mean, a few of the more popular ones. You mentioned some of the mutual fund side. We can get into some of those in a sec. But looking at the ETF side, we have a lineup of models, I guess. Core solutions is what we're
Right.
calling it. An inventory of funds that is more global equity potential on we call the all cap world.
Yes.
Core solutions, and then the inventory of funds that is very core US focused inventory of funds. One saw a change and one didn't, right?
Yeah.
And probably the US core one, smaller inventory, no change.
Right.
All cap world, global inventory, a little more nuanced funds within there. We did see a change there, right?
Yes. In all cap world, we have the ability to pick 2 ETFs, and they can come from a kind of a spectrum of different ETF philosophies and different items in there. And so we had a little change there where we swapped one version of a large growth US for another version of a large growth US. And that's because really the large cap US large cap and growth are still holding on to that leadership. So That's an example of a minute change. It could be meaningful. For example, people use different active managers. Why do they use different active managers versus one? Well, because those active managers do different things.
Right.
And the reason we have inventory in our models that we do is not because they're repetitive. It's because they're different spectrum of a particular rainbow that we're chasing. So that is to be expected. There could be a change, and at this point, that was the change really in the core lineup was really a move from one type of large cap growth to another.
And there's, I mean, no fund's going to be exactly the same, right? And so even though they might seem from the name or just knowledge of it being
Right.
like, well, if we're selling Qs and we're buying the ILCG Morningstar Growth ETF, like that seems to be very similar. And the score
Yeah.
for Qs is not a terrible score.
Right.
It's third in the lineup, right? But you look at the underlying sector breakdown, it's a little bit different. You look at the underlying holding breakdown, that's a little bit different. So
Yep.
like you said, I mean, they are different funds, and that led to different scores. So that led to the other. I mean, you look at the
Right.
score direction standpoint, QQQ is a negative score direction, and the Morningstar Growth ETF ILCG has a positive score direction.
Right, which means it's still improving or
Right,
is in an
right.
improvement mode. But this is how it works: is that you're either quickly changing to very different things, or you're migrating through things that do have associations with each other, but their weighting scheme of the internal of the fund and their true strength of what they're doing is different. And so this is what you want the model to do. You want the model to sense if there's a difference strong enough to make that change.
Right.
Yep.
And in looking at some of the other changes in the inventory, right? On
Yeah.
the website, you can pull up the full universe and you can see the score breakdown. And there's some other kind of interesting movements. I know I've gotten some questions. This model has the potential to go international.
Yeah.
International is like the hot topic from
Right.
everyone sees China up 10% a month. And it's
Yeah.
like, oh my gosh, is your model going? Well,
Yeah.
no, we didn't see those scores rise. They did
Right.
tick up, but
Yeah.
they're not near the top. We did see value tick up
Right.
in score, right? I mean, if you look at that score direction, value funds, while they didn't improve enough to come into the model, they have some of the higher score directions of any of the funds in the inventory.
Yeah, what we've seen during approaching the seasonal quarter, which mean when I say approach, it starts maybe, in March and April, there's a little bit of an approach, and then it starts to mature. What we've seen is there have been improvements in international, where a model is allowed to do international. We have seen improvement in international funds. China has moved up big time, let's say, but that doesn't mean China's allowed to be in any model.
Right.
Right.
It had a ways to go.
Right. And a general reason for that is the hyper volatility of China tends to, in some of our models, we tend to say that it's too sensitive,
right,
to allow for a model of this type. And so, but yeah, back to international's improved, and then values improved. The values improved greatly in 40 days, and for this reason, we almost saw. I think we did. Technically, was a value shift towards value, slightly or in a bigger way, across most of these models.
And we saw that in the T-Row model, for example.
Right. Their value fund, which is a stellar value fund, almost made it into our top 5.
Right.
We do have mechanisms that say you have to beat, some funds we own by this amount in score to get in. It almost did it. So but it does show that the value proposition is strengthening. And we've seen it across other models where this has also happened. And of course, we see it in our group scores. So this is the idea of the seasonal change. Could this mean that value trend will continue to get stronger and stronger and stronger? Yeah. It could. We just took a step. You can't solve 1 year, 3 year, 5 year, 10 years worth of problems in one day. Right. You step with it as things occur, and it very well could be that value continues the migration to get stronger. As we move through this seasonal quarter, and since we don't know the future, that's why we have these indicators.
Right. Exactly. Yeah, we don't have a crystal ball. It's kind of why we use this scores, right? Not saying the scores are a crystal ball, but I mean, that's kind of like how we're looking at it,
Right.
right? As an indication of, hey, this stuff is strong. We want to be in these areas
Yes.
that have maintained strength and leadership until they're no longer leaders. When they're not leaders, we'll rotate out.
Yeah, to give you a current example, American funds in our top 2, top 5s and
Mhm.
models there, they had an interesting shift as well, where Growth Fund of America, which as most people know is one of the largest, oldest growth funds, mutual funds out there, moved out of the lineup and was replaced with Washington Mutual Investors,
Which is more value.
which is a classic large
Yeah.
cap value fund, one of the great large cap value funds
Was that surprising?
of all time. No, because when you see the groups strengthen in value, you expect to see that translate into actual active or passive
Right.
managers, and if you don't, then something
That speaks
Yeah,
to some of the active
yeah,
management that they're doing.
absolutely that they're tapping into this thread that is in the market. So I thought it was an impressive change, and like I said, if value continues to blossom, then that's a great move. As you know, the markets in different years, they move back and forth through the quarters of what they prefer. But that's why you got to take these changes. You don't know that this isn't a long-lived
Mhm.
trend.
Mhm.
And of course, American Funds runs their product so well that if the market took a turn against them, they'd still do fine,
Right.
with their diversity. But
But in terms of the models have, I mean, not going to get into the weeds of all the performance breakdowns, but we've seen the more trend following momentum approach we've talked about a lot in our research that has done well in other areas
Yeah.
throughout this year. It's also done well. I mean, the scores have showed
Yeah.
the same story, right?
Yes,
You're seeing
absolutely.
areas that have there's the trend following, momentum following approach has played off, has been beneficial from a just a straight performance standpoint this year.
Right.
Would definitely be something that's continues to be monitored throughout the next few months.
Yeah, and historically, sometimes when we see a low momentum market, which we saw last year,
Right.
in prior months,
Arguably
before
longer
that-
than a year.
Oh, it was 18 months,
Yeah.
but let's say prior, the generally what happens is a low momentum market is slightly rare, does occur, did occur, but generally followed by a strong momentum
Mhm.
for quite some time. So you have to stick with things, and you have to say, "This is my discipline. This is my strategy." The model's making adjustments along the way, but then you
As
got
they're supposed to do.
Yeah, yep, and then you have to you tell yourself the momentum is coming back, which it did. So
Right.
right there at interestingly at the last seasonal cycle, which was let's say early November, that momentum trigger the momentum funds picked up speed right there in the a week or two right before that. So we bought momentum funds
Right.
at the beginning of the seasonal cycle. So it's not that we plan to do that. It's just that's the way the market works.
Right.
So the inventory is supposed to be there and the indicators are supposed to be there, but to tell you what to do in real time. And that's exactly what it did, and it worked out right on schedule, as it generally does. So, and then we got to keep going down the rest of the road. Some say this is an election year. There's evidence that election years sometimes do differently than the average year.
Mhm.
I would throw on top of that post-election years, whatever that would mean. It doesn't mean we can forecast things will be good or bad. It's just that we're following the trends that we have, and the
Right.
trends are saying that the core of the U.S. is very strong, and that these particular assets or mixture of assets of value and growth are doing very well.
Right.
So
Right. I think the mixture is an important thing. I mean, that's momentum a lot of times. I mean, the trend following approach, using trend following and synonymous with momentum, right? I mean, that approach gets lumped in with growth all the time. It's just like,
Yeah.
oh, it's momentum, that's
Right.
growth. But the beauty of it is that it can go into other areas.
That's
It can
right.
go into areas that are performing well. Kind of like we saw or definitely like we saw with these fund sport changes.
Yeah, and if you check back on your history, early 2000s, through a period there, that the high momentum is in value, the high momentum is in small cap,
Right.
the high momentum is in non-US.
Because it's been growth the past few years doesn't mean it always has.
Right. So it's key Two, have your definitions, rebrush off your definitions. That momentum means we go where the leadership is. It doesn't have to be a specific single fund or a specific single nomenclature that you're always going after. You need to go after where the momentum is strong, and then the indications tell you where that strength is. And the score is certainly a primary way to do that. So comparing, various funds and looking at their scores will tell you, what is the market preferring as far as large, mid, or small, or international, or other things. So,
and as those trends change, I mean, we'll continue. Scores are updated every single day.
yes,
Models, as we talked about, are not checked every single
right,
day.
right,
We want to give them time to breathe, as you said, a little
Right.
bit. So, I mean, the next evaluation for this seasonal evaluation is going to be at the beginning of August, right?
yes,
And
early August. Yep.
yeah, and so the models are going to come back in, and at that time, and we'll see if the scores have stayed the same. If we've seen consistency, or we'll see if some of these other trends have further developed into be more longer term leadership changes.
Yeah, and again, that will get us, halfway into this semi-seasonal year, and we're looking forward to it. Keep in mind, we have the seasonal models, we have the monthly models, and of course, the website, as you mentioned, is updated every day, so people can feel like they're really in tune with these things, and then gravitate towards models that you would prefer to use. We have a variety of models that pay attention to active managers, and then we have a variety of models that pay attention to passive indices, and then we have models that blend them together, fuse them together. So, I think very much would be interested in taking a look at those types of models on the website.
It lends itself to customization or flexibility in terms of where it can go, because at the end of the day, it's just a score, right? 0 to 6, what's strongest?
Right.
Try to be in those areas.
Right.
So great, yeah. And with if anyone has any other kind of questions, I know we got kind of in the weeds on the website stuff with some of the different models and different examples that we're going through. If you have any questions on those, definitely be sure to reach out to us, dwa@dorseyright.com. And we'll be more than happy to help you out and show you where you can see the models. But with that, Steve, I think that probably brings us through at least a few of the models. And like I said, we won't be hitting on all of them. But thanks again for hopping on this week.
Thank you for having me.
And thanks everyone for tuning in this week. And we look forward to talking to you again next week.